So now we are going to start with the topic name is fixed asset accounting. So what is the meaning of fixed asset accounting? How importance in organization of fixed assets? How we are going to do capitalization, creation of the asset master data, when you need to do the capitalization, how you do the depreciation run in month end, what kind of depreciation methods we have, when we do the retirement of the assets, and what is the meaning of transfer, what kind of asset related types of business transaction we will see now. Before going to detailed description about the asset accounting, we'll go with the assets. So basically, these assets are categorized into two categories in terms of our financial statements. Current assets, non-current assets. Current assets is basically for short term our our business day-to-day business operations. When we are doing the business day-to-day operations, we can convert those assets into cash within a very short period. Non-current assets mean long-term assets. In our financial statements, we can see current assets and non-current assets. Current assets all will go to the short-term assets. Example of accounts receivable, cash, stock, advances to the vendors, prepaid expenses, and these all will going to the current assets. This is what we call as a short-term assets. The second category of assets is non-current assets. The non-current assets under category only we have fixed assets. These long-term assets we can also divide it into tangible and intangible assets. So what is the meaning of tangible assets? What is the intangible assets? How we can able to identify whether it is the tangible or intangible? We can see. Assets are basically categorized into two categories. One is for tangible assets, another one intangible assets. For tangible assets, we can see we can able to touch those assets. Example, popular examples of plant and machinery, furnitures, property, plant and equipments, cars, vehicles, any laptop or any kind of equipments, any landed building, any machinery. These all are comes under the tangible fixed assets. We can see those assets. We can also touch those assets. We can feel that assets. Whether we can see where it comes to the other assets, intangible assets. So intangible assets basically we will not able to see those assets, but there are the assets which are recorded in our books of accounts. Example, popular examples are goodwill. Goodwill is the basically it will be generating the revenue to the company, but we are not able to see those goodwill in in with our eyes. But it is giving a benefit to the company, the goodwill of our company. It will be giving some brand value to the company and it will be giving some additional revenue in terms of generating the sales. By selling up that sales and providing services, we will also get some additional revenue. So that is the assets which we also need to record in terms of intangible assets. How you are going to be depreciate for a tangible and intangible means tangible assets we are going to run the depreciation, what we call as the depreciation for methods. We have straight line method, we have double derivative method, we do have different multiple methods. Mostly companies will use these two methods, popular methods, but mostly straight line method and double derivative method only we will use it. We will have few more methods also like unit to measure, unique fund method, production method, like there are different methods also, the annuity method. Those all are methods which we can see in the books of account, but where it comes to the practical point of view, tax purpose and accounting point of view, will mostly popular will be SLM straight line method, double DV written down value method. Those two methods are popular. In a company's point of view, mostly companies will use SLM method only. I have seen so many companies. Now coming to the depreciation amortization difference. When you go and attending the interviews in companies, you can expect this is the common question. What is the difference between depreciation and amortization in terms of assets? Usually for depreciation due to tear and wear, it is decreasing of the our assets value. For that purpose, life is span of life is decreasing. So that is the purpose we are using that asset. The asset life is going to be decreased. Generating revenue to the company assets, life of the assets is decreasing because of the technology, because of the timing, because of the tear and wear. So now, as a company point of view, the revenue is generating by using of this asset. Opposite way, you need to book an expenditure as per the matching principle. Revenue should be recognized one other way. Opposite way, you need to book on expenditure pertains to that revenue is generating. ఆ రెవెన్యూ వచ్చేదానికి మనం ఏదైతే ఎక్స్పెండిచర్ ఇంకర్ అయ్యామో expenditure also need to be booked in our books of accounts in terms of depreciation. Same way, by using of this asset, you will also get from revenue. Revenue also recognized. Expenditure in terms of depreciation gets posted. This is the two matching principle point of view. We should supposed to be run the depreciation. It will be based on monthly. We will execute the month end execution of workday 1. That process also we will see. Where it comes to the amortization for intangible assets. Usually, we will see the copyrights, patents, trademarks, brands. This all are comes under the intangible assets. Suppose one brand is there like TCS, one brand is there Infosys, one brand is there like Infosys, Wipro, like they all top big four companies, big like Deloitte, PwC, like they do have some brand. The brand will give some additional customers by earning up the additional new customers so that they can get some additional revenue to the company. Same way, the brand value also will be calculated and be maintained in their books of accounts. Based on that brand, they are generating some revenue, right? So same way, they need to charge the expenditure of that brand also. That what we call as a amortization for intangible assets. For amortization of the intangible, how will we do amortization means like based on the period. Suppose goodwill, we need to amortize over the period of time, maximum 5 years, 10 years. Like company will provide some policies based on our what we call as accounting policies. As per the policy and as per the standard, we should able to amortize this many years. Like that, we will have the standard. How we need to treat the accounting treatment, we will know based on the accounting standards. How we need to do the accounting treatment of goodwill, how we need to do the treatment of brands. So there's everything we will get to know for amortization of the intangible assets. These two are the categories of the assets. Now, why we are doing the assets capitalization? Why? What kind of expenditure? It is a capital expenditure or operating expenditure. How you will get to know? What is the criteria? What is the limit up to capitalization? These are all questions you can expect in interview point of view. Generally, we are using these assets for our administration purpose or for our production purpose or providing the service to the customers. We will use these assets. By administration purpose means suppose you are taking one building, that building you are using for our employees sitting and then they are manufacturing one product, they are providing some services. That building is required. By using of that building, we are able to provide the services to the customers, and by using of the building, we are able to provide the services. In the return, we will get the revenue. So ultimately, the building or whatever the machinery or whatever the property which we are using for our business purpose, either for production purpose or service purpose or administration purpose, this will be the giving the benefit to the company over the period of time. It's not only one period. It's not only 2 periods. It's give more than one accounting period. In that case, we should supposed to be treat this all. For acquiring of these assets, you are incurring some expenditure. Those expenditure we call as a capital expenditure because these assets are giving the benefit to the company long term period, not only one period, more than one accounting period. That is why we usually do this all assets. We treat it as this all asset related expenditure, capital expenditure. It will be giving the benefit to the company over the period of time. This capex, whatever the capital expenditure we call as short term, is the capex. This capex, whatever your expenditure is incurred for acquiring of the any assets, is called as a capex. For OPEX, OPEX means operating expenditure. What is the meaning of OPEX? OPEX is basically any expenditure you are incurring for day-to-day operations to running our business. We call as a OPEX, operating expenditure. This operating expenditure we need to charge to P&L account. Where it comes to the capex, capital expenditure, we will move to the assets, and that assets will show in the balance sheet. So capital expenditure every month we charge to the P&L account, but where it comes to the OPEX, capex, we need to show balance sheet. OPEX it will show at the P&L, because this asset is giving the benefit to the company based on the useful life of the asset. So now you got little bit idea about the how types of assets and what difference between depreciation and amortization, and then what is the difference between capex and OPEX. So what is the purpose of assets? Either to provide administration or providing provision and any kind of production purpose, we purchased assets. That assets we are using. By using of that assets, we are generating revenue in terms of sales. Same way, we need to also book the expenditure in terms of depreciation or amortization, so that our financials will match it, like revenue versus expenses. So that is the purpose of doing the depreciation and amortization. And also we are using that asset life is going to be decreased due to wear and tear and technology process. Wear and tear means when you are using that asset life is going to be decreased. So to decreasing that asset life, the cost also need to be decreased, because end of the day we need to replace the new asset. For that purpose, every month as and when you posted one asset, that should be posted depreciation also against that depreciation. So now when you need to do the capitalization, this is very important one. Whenever you go and attending interviews, when you need to do the capitalization, generally usually do the ready to use and put to use. What is the meaning of ready to use, put to use means? Suppose I purchased one laptop today, I can ready to use immediately, but I purchased one building. That building is still not yet completed. I'm not yet ready to go and stay there. I need to do some additional work inside that building. Suppose I need to do some inside furniture work, cub work, and some other stuff, all the work. Then only I can go and you can use that building, right? So that is the main meaning of ready to use and put to use. Ready to use, or when the asset is put to use, on that day only we need to do the capitalization, not actually when you purchased. Maybe I purchased today land, but that land is not useful for me. Maybe when I constructed the building, that building is ready. When I occupied that building, and when I started the business doing of that using of land and building, then only I need to do capitalization. Until that, what is the asset is called as a capital work in progress, or AUC, asset under construction assets. For AUC assets, we are not supposed to do the depreciation. Only capitalized assets, when you do the capitalized, then only depreciation is get started. What is the difference between AUC assets and normal assets? You can expect. AUC is assets under construction, capital work in progress. Till this assets is not yet ready, we are not eligible to run the depreciation for this capital work in progress assets. And now the point is here, what is the value you need to do the capitalization? How much amount you need to do the capitalization? That also very important. Generally, APC means acquisition cost. Whatever the asset you are purchasing, that acquisition cost, and also you are that asset. Suppose I purchased one laptop. That laptop consists of one transportation cost from the stores to bring my office. that cost also I incurred. That is one time cost. And I also involved some kind of installation charges, wages for installation of those assets. That also I need to do as my asset value. Then total amount of that acquisition cost plus transportation cost plus installation charges all together I need to do total amount of this 1,15,000 only capitalization. And this only I will calculate the depreciation, not actual base value of the asset. This is also part of this asset. Why? Because to bring this asset to my production unit, to work this functionality of this asset of laptop, I need to install software. Those also I need to do capital expenditure. But every year you are maintaining some maintenance cost. Those will not comes under capitalization. It will go to the OPEX, operating expenditure. Like every yearly annual maintenance you are going and doing some kind of service to functionality of your laptop. Same way company's point of view also maintenance cost, whatever there, that is not part of the capital cost, that will go to the OPEX. CAPEX cost is one time cost. So to bring functionality, if any increasing of the asset functionality efficiency, those cost only you need to do capitalization. For running of the any assets, like asset running purpose, you are incurring some cost, those you need to charge to the OPEX. OPEX means operating expenditure. CAPEX means capital expenditure. So those are the meaning of the CAPEX and OPEX, and I will try to discuss tomorrow regards to the depreciation point of view, because already 11:35. Okay, we'll see tomorrow. So now the depreciation methods point of view, one is SLM method, straight line method, another one is W method. How we will be calculated, those things we'll discuss tomorrow. So that is the just little bit about the theory asset accounting point of view. So we'll connect with tomorrow asset accounting point of view rest of the